Hey everybody, thanks for logging in to our webinar here at the Lynn Group. This time, we've done some webinars this year, right? We did a Medicare one with Tana, we did one on the election and some tax proposals. This time is now just full-blown taxes. So if you thought the other ones weren't fun, wait till you see taxes, right? So I'm Mike Mansfield. I'm the owner of the Lynn Group here in Ventura, California. We focus on retirement income planning. And an important component of retirement planning is really looking at people's household finances and everything that they have going on, from your legacy to your estate planning, obviously Medicare, tax planning, the timing of Social Security. There's so many components that go into actually picking investments and giving you good financial planning, retirement planning advice. So Connor, which you can see his beautiful face on here, Connor is our in-house tax preparer. So he helps all of our clients obviously prepare their taxes at that fun time every year, typically April. This year it was special, right? As unique as July. He helps our clients prepare their taxes, gets them all done, gets them all filed, all of that fun stuff. But Connor and I have a very important philosophy about taxes, and that is preparing is simply recording history. And sometimes we don't like the history we're recording, right? We want to change the history. Yeah, that's like a weird, hot topic for the country. I don't know. But so we focus on tax planning. And when it comes to tax planning, there are certain things that you can only do inside of the calendar year, whether that's a charitable contribution or buying a car for your business, whatever that thing might be. There are certain things that you can only accomplish for your taxes inside of the same tax year. And so Connor focuses the fourth quarter of every year of really helping our clients plan their taxes to make sure that they're making good, healthy, efficient decisions. So Connor is a licensed tax preparer. He's actually he's an accountant. He does QuickBooks. He does bookkeeping. He does payroll. The guy does it all. He's the beautiful mind. He's Russell Crowe. Was that the same right movie? I don't remember. So, anyways, I'm going to turn this over to Connor, and he's just going to hopefully not derail this conversation too much. So, Connor, thanks for obviously being a part of this. And what do you got for us, man? How are you going to save us in our taxes?
Firstly, hey everybody, my name's Connor. I work out of Mike's office. I focus, like you said, on tax planning, tax preparation. I've already been doing tax planning for a good part of this year, basically since last tax season ended in July. So we already have a good, strong hold on this year. Like Mike mentioned, a big part of our tax planning policy is we try to get people's taxes figured out before the end of the year. By the time next year, by the time January comes, it's all set in stone. We're out of options. So we have until December 31st to make a lot of these big decisions.
Yeah.
So 2020 has been a very interesting year for all of us. In March, COVID-19 was announced, and our whole government kind of went into a shutdown. Many businesses were closed. The CARES Act was passed in March, which was the Coronavirus Aid and Relief Act, and it offered a lot of us some stimulus, which helped out in these times of financial need. One of the big parts of this act was the $12,000 stimulus payment. We also got rid of required minimum distributions. Many people are receiving unemployment when they're out of work, and they also added in a little extra candy, which was the above the line charitable contribution.
Only a tax preparer would call that candy.
Well, they've been talking about it for so long. I was excited to see it finally in the law. So that's definitely something that I want to utilize this year for a lot of my clients.
Okay.
In addition, we have Roth Conversions and Contributions. The conversions are something that has to be done by December 31st of this year. So we're going to talk more about Roths later, but this is a big topic that I really wanted to talk about for this year, because really 2020 has created a perfect storm for Roth accounts. We have a few small business clients. I wanted to talk on a little bit of small business deductions, pushing out some payments, maybe making the purchase of some new tools or a vehicle this year and seeing how that might affect your taxes. And then I wanted to talk about capital gain and capital loss planning, and really looking at your investments for the end of the year to make sure you know how much tax you're going to owe based on how good your accounts have done this year.
Good. Well, only Connor can make taxes fun, so this is exciting.
They are fun. They're fun. All right, so our $12,000 stimulus payment. If you were a married filing jointly couple, you probably received $2,400. If you had kiddos, maybe $500 each for them. These payments are not taxable on the federal or state level. A lot of people are concerned about this, and they've said that these are not going to be taxable. In addition to them not being taxable income, these are actually advanced tax credits. So this is something that prematurely has offset your 2020 tax balance. And in addition, there's no clawback. So these $1,200 payments, they were based off your 2018 and 2019 taxes. If you made a lot less in 2018 and 2019, and all of a sudden in 2020 you wouldn't be eligible, they're not going to ask for that money back. So that's a nice little bonus they gave us.
Wait, so that's interesting. So they use previous year tax returns to see if you should get the money, the $1,200 everyone got. If you wouldn't have qualified for it based on your 2020 income, you still get to keep all the money and they're not going to ask for it back?
Yep, you get to keep all the money. So
only in America, man. That's awesome.
Only in America.
Can I go amend my 2019 taxes so I can maybe get some more?
No, see, there's no need to amend your previous year's taxes because this is actually applying to your 2020 taxes.
That's funny.
For 2020 is going to be based on your AGI for this year. So if you didn't receive a stimulus payment or even the full amount, we can claim the rest of that credit this year. And that's a big part of this tax planning. We want to make sure your AGI is within that limit.
Okay, so sorry, and I don't mean to keep interrupting you, but I find this interesting also, sadly. There's obviously something wrong with both of us. So if you didn't get the $1,200 because you didn't qualify in a different way, maybe because your income was so low you didn't file a tax return or have a bank account on file or something like that, so they didn't send it to you, you can still go in when you're doing clients' taxes and request it as like a tax credit?
Yep. Yeah, exactly. The IRS is currently in the process of building a tax form for 2020 that is specifically designed around this stimulus and recalculating the credits for people who maybe didn't receive their full payment or didn't receive.
That's very cool.
Yeah.
Okay. So the government gave everyone money, whether you qualified for it or not. They're not going to take it back. They're not going to tax it. And if they forgot to give it to you, they'll give it to you anyways.
Yep, exactly.
Oh my gosh. I love it. Okay.
And if you received a little bonus credit in 2018 or 2019 because you claimed, let's say, a dependent child, that dependent can actually go out in 2020 and claim themselves as independent and claim the whole $1,200 all over again. And then they're not the previous dependent credits back.
Oh, that's funny.
Yeah. So this is all part of that tax planning process. Maybe you had somebody that you were planning on claiming as a dependent this year. And maybe because of this, there's another incentive to get them off your tax return.
Oh, that's interesting.
Yeah. Another big topic this year has actually been unemployment. The federal government gave everybody on unemployment an extra $600 a week for a number of weeks. And so people's unemployment benefits this year are substantial. In many cases, it almost completely replaced people's earnings for the year. A lot of people don't understand that unemployment is taxable income.
It's funny you say that because that's a question I get all the time. I got unemployment, but I don't have to pay tax on it.
Yeah.
I thought you did.
Yeah, no, it's a weird one. It's not taxable in the state of California, but it is taxable on the federal level.
Okay.
And as you know, federal tax brackets are much higher than California's tax brackets, even though we live in a very taxable state. So this is something that we want to plan for. If you received unemployment benefits throughout the year and you didn't have taxes taken out or even not enough taxes taken out, we want to plan for that. We want to know how much tax you're going to owe based on those additional payments that you weren't necessarily banking on.
Okay, so what you're saying is people might have made more money than they were kind of planning on in the sense of what the unemployment payments were, and that's obviously relative to perhaps what they were actually physically making. If they lost their job. But I think what you're saying is it's pretty common for people to not do like a federal tax withholding on this stuff.
Yeah.
And so you might end up owing more tax than you think because you didn't realize that all of that unemployment was taxable. And wouldn't people end up with some kind of penalty if they didn't pay their taxes correctly?
Yeah, they assess an underpayment penalty if you haven't paid in enough tax throughout the year.
Okay,
based
so that's
on
probably a good thing to look at pretty immediately instead of waiting till next April at the last minute to say, oh, whoops,
yeah.
how much do I owe? Because then you'll end up with a penalty on top
Yep.
of it.
And those penalties, they can be pretty substantial. I've seen underpayment penalties, $500. That's an extra $500 you don't have to pay, and that's just part of this planning process, making sure we know about it beforehand. With this unemployment, we were talking earlier about keeping our AGI low in the case of the stimulus payment. Unemployment's going to add to your AGI, so it might bump you out of certain credits or deductions, we'll say, that we don't necessarily want to lose that eligibility for. So being able to plan around these extra benefits is really, really important, especially for people who aren't used to receiving unemployment.
Okay.
A big part of the CARES Act was actually the loss of RMDs. So in 2020, we are not required to take RMDs. As a quick reminder, RMD stands for Required Minimum Distribution. The government does not want your qualified account to keep growing and you keep deferring that tax. They want it now, basically. As of somebody who's age 72, they're required to start pulling money out of their account. RMDs in 2020, the loss of them really opens up a lot of opportunities for us. Roth conversions are not allowed on RMDs, but because there are no RMDs in 2020, we actually do have a Roth conversion opportunity available for us. This is a big planning thing for a lot of, we'll say, financial planning clients even, where we can shift some money out of those taxable buckets and into a tax-free bucket of money.
Yeah. So I guess to put that in context, so in simplicity, if you have an IRA or a 401k, in simplicity, you have to take money out of that account at 72. Well, let's just say, for example, they calculated your required minimum distribution to be $20,000 this year. Connor's saying you don't have to take it out this year. That's what the law says, is they're letting people get out of that and paying the tax. But he's making an argument that, well, what if you took that $20,000 out anyways and you put it into a Roth account that is now tax sheltered, growing tax free, and still paying the tax on it? So it's just kind of a way to manipulate the required minimum distribution game this very unique year. That's an interesting idea, Connor.
Yeah, and then those RMDs, since there's a required fixed dollar figure on them each year, we actually have flexibility this year where maybe we don't need to take that full amount that we were planning on.
Sure.
In the case of, let's say, it pushing you over to a new tax bracket, or the same thing as earlier, the loss of an AGI credit or deduction. We have some flexibility there as far as whether or not we want to take out some or all of that RMD for the year.
Okay. That's a great idea. Now, I think to your point, though, if you do a Roth conversion, what's the time period that you can do those ones?
Roth conversions have to be done by December 31st. So as of the end of 2020.
Okay. So another compelling reason to have a conversation with your tax professional, hopefully Connor Sharon.
Yeah, that's a big one I wanted to touch on, because those Roths, they're powerful this year for a lot of people. Mike, you do a lot of financial planning, a lot of cash flows. Mm-hmm. Do you think that it makes sense for some people to take their RMDs even though they're not required for this year?
Oh, absolutely. So that's funny you're saying that, because that's been a big conversation with the majority of our clients. We have a lot of clients that are over the age of 72. We're pulling out required and minimum distributions. And I'm an advocate of tax planning, as are you, Connor, in the sense that, in a different variation, is sometimes paying a predictable tax rate is 10 times more attractive than paying an unpredictable tax rate, 5-10 years down the road. We have a exploding debt in the country. We have a lot of uncertainty with what tax policy might look like over the next number of years. And so to me, at a minimum, paying the tax, pulling the RMD in this year is very attractive because of the tax liability. Now, granted, everybody's situation is unique. If you use that RMD for income, you might need the income no matter what. It doesn't really matter. You need that cash flow off of this. At the same token, if you don't need it, then it goes back to my conversation that pulling the money out might be very tax advantageous in the long haul. But to then reinforce Connor's point is, you can kind of go one step further, maybe pulling the money out, as I'm saying, paying the predictable tax on it, but sheltering it in a Roth account because you don't need it for income purposes might be an entertaining way to kind of leverage the system and know that you can have some tax-free growth in your portfolio.
No, absolutely. And that's a great example of how closely the financial planning and the tax go together. When I'm able to sit down and talk with Mike about these specific accounts, these specific clients rather, and figure out exactly what makes sense, what's going to save them the most tax, and what makes the most sense for their financial future. It's really a powerful thing. The last part of the CARES Act that I wanted to touch on was that little bit of candy. So the standard deduction raised substantially in 2018 with the Tax Cut and Jobs Act. And with that, there's a lot of taxpayers who are no longer itemizing. They're not taking a deduction for their home interest. They're not taking a deduction for property taxes, their charitable contributions. So in March of 2020, they implemented this little above the line cash contribution deduction that I've been hoping they put into place for a while now.
Okay.
So people who take the standard deduction in 2020 can take up to $300 as an above the line cash contribution deduction on their 1040 tax return.
Ooh.
$300. It's not a whole ton, but we're talking about maybe a 22% tax bracket. That's an extra $60 you're saving yourself for the year. So it's a nice little added benefit they gave us for the year.
I feel like you're trying to nickel and dime the IRS here, Connor. Let them have their $60.
Whatever we can get, right? Whatever we can get. The IRS also realized that many people aren't making as much money as they used to for the 2020 tax year. A lot of, let's say, businesses maybe have laid off employees, and people just aren't making as much in some scenarios. So they've gotten rid or they've given people the ability to suspend the 60% AGI limitation on cash contributions. This is specific to people who take the itemized deduction.
Okay.
But as an example, if you're somebody who has an AGI of $100,000, you can't contribute more than $60,000 in charitable contributions normally. This year, they've gotten rid of that. So if you're somebody who's charitably inclined, we don't have to worry about that for this tax year.
Nice. This is a good year to give to charity.
Good year to give to charity.
Okay.
I really wanted to dive into Roth contributions and conversions just because this year it's such a perfect storm. There's so many opportunities for so many clients, and I don't want people to miss out on this. Again, in a lot of scenarios, Mike, this is something that has to be done by December 31st, and once we get into January of next year, it's the past. We can't change it anymore.
Yeah.
So something like a Roth contribution, we actually have a little bit more freedom. Roth contributions are non-deductible upfront, so you don't get any sort of write-off on your taxes. But as that investment grows, when you pull it out at a later date, you don't pay any taxes on that growth. It's a very, very powerful investment tool for somebody who plans on making more money in the future, or even, let's say, okay, for example, Mike, what would happen if somebody took $30,000 out of an IRA for an emergency?
They get punched in the eyeball by the government.
They get punched in the eyeball. They owe a ton of tax, and if it's somebody who is already in a high tax bracket, they may owe tax above and beyond
Right.
what they expected.
Yeah, compounding problem. Yeah.
Yeah, no, a $30,000 distribution might actually cost them $50,000 at the end of the day when they pay all the taxes on it.
Right.
So these Roth accounts can be very powerful. The contribution limit is $6,000 for this year, plus $1,000 if you're over 50 years old as a nice little catch up. Roth contributions need to be completed by April 15th when you file your taxes.
Yeah. So I might add a caveat to that. So I think with the Roth contribution, we're kind of talking about probably the little younger people that are still working, still making money, still contributing. And contributions are always income based. I think that's what you're saying, Connor. It was the perfect storm this year, because if your income went down, if you're normally in the 22% bracket and now you're in the 12% bracket, it might make a whole lot of sense to fund the Roth this year versus the pre-taxed account that you normally do. So you got to manage the tax brackets based on the situation. Another thing, just to kind of throw a wrench in the whole thing, is some employers, not a lot, certainly not all, allow for Roth 401k contributions. Same exercise. this might be a lower income year. Maybe you got less hours. Maybe things aren't going as well. Maybe you changed jobs after losing a job. And so funding a Roth 401k could be one of those scenarios in order to take advantage of what we're talking about. To that point, though, Roth 401k can only be funded, I think, through the end of the year because it has to be through employer salary deferrals.
Yeah, very true. So a Roth 401k would have to be funded by the end of this year.
All right. Too many rules.
So many rules. That's why I'm here, though. I keep track. On top of the Roth contribution, we actually have an even more powerful thing available to us, which was the Roth conversion. So Roth conversion takes qualified assets, let's say a 401k, an IRA, a 403b, and it actually takes that money, pays the tax on it, and puts it into a Roth account. So it costs money up front. Yes, you are paying tax at today's rate, but you're deferring that income, or rather, you're getting rid of any tax on that income as it grows in the future.
Okay.
Roth conversions can be incredibly powerful for people, especially if this has been a low income year. We talked about earlier using an RMD actually as a Roth conversion. If you don't need to take that $20,000 out that we mentioned earlier, but instead you can just convert it into a Roth. Now you have that bucket of money that is tax advantage. You don't have to worry. If you need to pull $20,000 out, you can pull it out and not have to worry about any of the taxes associated because there aren't any.
Sure. So I think your point is that mandatory distribution we talked about converting earlier to a Roth is really specific to people 72 and older, whereas a Roth conversion in general, everybody is eligible. So if I understand this right, even if you're under 59 and a half, where there would inherently be tax penalties, you can convert from an IRA to a Roth as long as you pay the tax, and you're not subject to that penalty, right?
No, there's no 10% penalty for converting.
No, anybody can convert. So if you're having a rough tax year, this could be a very good year to consider doing this.
Yeah, let's say
I got rough tax year is a relative term. That can mean a lot of things. But if you're having a rough income year, then perhaps this is a compelling idea for a lot of people.
Exactly. So these conversions, they need to be completed by December 31st. So we really only have another month and a half to plan around what your income is right now and how much we could convert in a Roth in order to keep your tax within a reasonable level.
Okay. So this is something we'd have to jump on and consider.
Yeah, there's a lot of planning that goes into this. Do you feel like it would work for a lot of your clients? Do you feel like this makes sense?
Well, everybody's kind of case by case, and that's what's funny is we get a lot of people that watch these videos, and so obviously existing clients, they share it with other people. And I think this conversation is probably, well, no, it's specific to everybody. The one thing that's interesting about a retired client, though, Connor, is most of our retired clients have very stable, predictable income. They have their pension, their Social Security. And so we're not really looking at much of an income variation this year to say, oh, unique opportunity. So this conversation at the moment, I think, is starting to bleed a lot more into those are still our working clients, the people that are still accumulating, still growing, trying to figure things out. So it's just case by case for everybody, as is everything.
Absolutely. All right. We have some small business deductions. So we won't stay in here for too long. We don't have too many clients that are small business owners, but there's some good opportunities this year to save clients money. With Biden recently winning the election, he's talking about repealing the Tax Cut and Jobs Act, which is—
He hasn't technically won yet, but okay.
Say that again?
He hasn't technically won yet, but okay.
This is true. He has not technically won yet. But if that is the case, we might get rid of some of these deductions that are in place right now. So we might only have this tax year, maybe one more to really take advantage.
Sure.
Self-employed people, they pay a lot of tax. You pay both sides of FICA, so you pay both the employer and employee side of Social Security and Medicare. You pay all federal income tax, all state income tax. Altogether, this can be a tax rate of over 45%. So, a deduction at the end of the year might save you a significant portion of tax. Let's say you spent $1,000 on a new computer that you needed for work. That computer might save you $4,500 or $450 on your taxes.
Wow.
If your business did well in 2020, which surprisingly, I'm having a lot of people come to me with tax planning requests that are showing great sales for 2020 that have really outperformed what we even projected.
That's good. What a blessing.
Yeah, no, these businesses, they've done well. So if you're one of those people that has done well in their business, this might be a good year to invest in new tools. We'll say a new computer, a new car, even. So something like a new vehicle that we could depreciate over time could be a very powerful tax planning resource for the 2020 tax year. In addition, if you have jobs planned for 2021 and you could pre-purchase some of those supplies, we might be able to pay those before the end of the year, before December 31st, and get that right off on your tax return, even though it doesn't, those expenses aren't necessarily for the 2020 tax year, they're more for 2021. But since your cash basis, we get that little extra deduction. In addition, we can push off some of those payments that you're due. Let's say you have a big accounts receivable balance. Push off those payments until 2021 so that we don't have to claim that income in the 2020 tax year.
Okay. I feel like you were talking to me.
Talking to you. Well, yeah, we've done a lot of planning.
I was literally ordering toners for the printer while you were talking that I don't need. I'm going to get 600 toners.
600
toners. 5 years of toners.
The last thing I really wanted to touch on was our capital gains and losses. So a lot of people don't know that investment accounts, we'll say taxable investment accounts rather, as the dividends are paid in the account and reinvested, as the interest is paid on those funds, as the stocks are changed from one to the next, or as you sell a position, there's capital gains and losses being accrued in that account that you have to pay throughout the year. A lot of people feel like you only pay taxes on distributions from the account, but these taxable accounts, you pay tax throughout the year as it goes along, and it needs to be reported on your tax return. Sometimes people aren't quite prepared, so maybe there is a big capital gain on their tax return that they weren't ready for. It's important to look at the investment statements and see kind of where you're at for the year so that we can plan what your tax balance might be at the end of the year. Capital losses. So a lot of capital losses unrealized, we can realize at the end of this year to lower your taxable income. Mike, you can write off up to $3,000 for the year in capital losses, and that gets carried forward every year. So there's a big...
For clarity for the viewing audience, I never lose money on my investments, so that would be a pointless thing to direct towards me, Connor.
No, that wasn't directed at you. That was just a planning opportunity. March was a big loss for many people. The market dropped, what was it, 26% roughly?
26%, peak to trough was almost 40%, man.
Was it really 40% peak?
Taxes, bro. Yeah,
oh my
it was probably the worst stock market drop anyone has ever seen in their lifetime based on time period and decline. Yeah, I mean, it's pretty fascinating. 5-week implosion in the markets. Now, granted, obviously the rally was equally as impressive, which is its own conversation. We'll do an investment thing in a couple of weeks. We'll get you there. Not to distract from what you're saying, as you were talking, I was thinking about a client. We have a new client that came in, very nice person, had a non-retirement investment account. We transferred the money over in kind to our custodian, TD Ameritrade, and then with the intention of buying new stocks, we had an investment plan all kind of curated and figured out for them. And when the cost basis came over, we realized that they had one position that had a significant capital gain in it. And so, remember, our job is to not just make a mess on your taxes for Connor to clean up. It is to help do good, healthy financial planning and income planning so that things are as efficient as possible. And when we built the client's retirement income plan, what we realized is in 24 months, when they retire and their income changes, we could actually liquidate that position in kind of a series of liquidations and pay no tax on it versus paying a healthy amount of tax on it now. And so it just I was looking at this long-term capital gains chart and realizing that it's funny how Connor and I do work hand in hand to try to figure out how to cash flow these things, because sometimes paying taxes is the best thing you can do, right? It's a reminder of how well you're doing. But if there's also ways to avoid paying the tax, how great is that? So if I'm reading this chart correctly, Connor, let's pick on married filed jointly. The way that I would take this is, I don't know, let's say that husband and wife make 50,000. Oh, let's median income's closer to 60,000. So husband and wife make 60 grand working.
Yeah.
So if they sell a stock at a $20,000 gain, putting them at this 80,000 mark, what you're saying is they would pay zero tax on the sale of that stock. So even though that 20 grand was taxable, it wasn't actually taxed.
Yeah, you would pay $0 in tax on that distribution on the federal.
That's pretty cool.
Yeah.
Which then is almost like a different argument, right? Because then you could say, well, what's the point of holding on to it, where it goes up another buck, and then you have 15% on it?
Yeah.
I said, okay, yeah, I like that. So, sorry, I feel like I was commandeering this slide. I apologize.
No, you're totally fine. This is
Got excited.
Investments and tax go so hand in hand together. Retirement planning and tax go so hand in hand. Things like being able to push off those realized gains until a year when your client had less income. It's a phenomenal strategy. It saves them so much tax down the road.
Well, and it's a fragile challenge too, because sometimes investment opportunity is 10 times more important than tax liability. If you buy a stock for $5, it shoots up to $10. It might be compelling to sell it and pay the tax versus waiting for it to fall down to $2.
Yeah.
And so we're always weighing the fundamental benefit of an investment versus the efficiency of tax liability.
Exactly. So
sorry, this is very unscripted, everybody. So we're just
you mentioned earlier that paying taxes on your investments is a good thing. You still stand by that?
Absolutely. I like I said, I think it's certainly case by case, but a bird in the hand. Sometimes you have to realize stuff. I mean, isn't the joking adage that it's not real till it's finally in your hands? And that's the problem with investing. Is it's like go the opposite route. The market crashed this year, right? And so in the moment, everybody was concerned, right? Their accounts are down. And so if you panicked and you realized that thing, then it became real. But if you didn't realize it and you hung on like a normal person should do, the prudent investor, obviously now you're patting yourself on the back.
Yeah. No, I agree. Paying taxes on your investments, I honestly feel like it's a good thing. It's
right.
You don't pay taxes when you're losing money. You pay taxes when you're making more. So it's always good to see.
Well, hey, Connor, we really appreciate you taking the time out. I know this is your tax planning season, so you are very busy working with people. But that's really what I would reinforce. The whole point of this conversation was to be a little generalized, help everyone realize that tax law has certainly changed this year. There's unique rules and guidelines that were put out there by the government. Maybe you got different income, maybe you have less income. Do not make the mistake of simply preparing your taxes in the following calendar year. All you are doing is recording history, and you might not like the recording of your history. In the same calendar year, you need to be working with your tax professional. Obviously, I'm advocating here, Connor Sharon. He does my taxes. I have very complicated taxes. I run multiple businesses on my taxes. My taxes are a mess. I put all of my faith and happiness and joy in him saving my caboose every single year. He's phenomenal at what he does. And so give our office a call, 805-500-7035. You can find some time to talk to Connor. That's 805-500-7035. And remember, share this link. This is on YouTube, so share this link with your friends. Shoot it out to your friends if people have questions. Obviously, let us know how we can help. And as usual, we appreciate all the feedback and love our clients, and best wishes.
Perfect. Looking forward to hearing from you guys.